So here's, again, and this is just, if you break it down, you've got two credit spreads, short a call, long call. Short a put, long a put. So two credit spreads, okay? So next we're gonna look at the long condor. So it's a different animal. So there's the iron condor and then just a regular long condor. So the long condor is going to be the opposite. I'll show you that in a second. So if it goes out between the two short strikes, you keep those max credits, and but you still have a cap trade. All right, but it's again a probability trade. So here's a kind of an example of one that we set up not too long ago. This was on Google. So it was trading sideways. So it had a breakdown right here. It broke that 50 simple. And so it was trading right about here. We were looking at the support resistance levels. And so set up this as a long condor. So sold the short strike was at 118. So you can see how far out of the money this was. Sometimes if you can get way out of the money, you've got a higher chance of that staying with under that strike price. So it was trading right here. So sold that about 1 standard deviation out of the money here, the 118 strike, and then sold the 105 strike. Okay, so at the time, those were about 1 standard deviation out of the money. So then here's what it looks like. So in this example, you've got sold you can see down below here. So it says the 9 September 105 put short, the 101 put long. Okay, so you're short here, the put here at 105, and then long, the put below it to cap the risk. So you're not, if this thing just goes, straight down, you're capping your risk. And then you bought that one below here. All right, so for doing that, brought in $40 credit on that side. Okay. And then sold the call credit spread. Again, you could do this all at once or leg into it. So then sold the call credit spread, sold the 114, bought the 118 at 62 cents. So here sold that call there, bought the call here, brought in $62. So on this trade, we had a total of $102 of potential profit. Okay, so we had $102 credit. And then our risk is the difference, the spread width less that 102. So 400 minus 102, the potential if we got it totally wrong would be to lose $298. Okay, so if it went out here at expiration below that strike, the 101, or above the 118, you'd lose $298. But if you kept the full 102 on this trade, that's a 34% return. All right, so again, though, but a probability trade. You're going into this trade with the 80% probability that price will be below 115 or below or above that 101. Okay, so that's a kind of an example of what the iron condor looks like.